Welcome to the final edition of On the Contrary for 2014. As we enter this final third of the year, there are just 4 months to go. It's interesting when we reflect on 2014 and how things have unfolded. We really had high hopes for 2014. You know, if you recall, our investing style and our process hasn't really worked very well in the last 2 to 3 years in South Africa, or even globally for that matter. So January was really a very big boost for us when we outperformed the market significantly, and we had a sense that 2014 could be different. But as it turns out, the remaining 7 months, from February onwards, the market has really resumed all of its previous trends. In this edition, we focus on a few things. What we've tried to do is separate global and local. We think on the global front there are much more opportunities available to us. The opportunity set is wider, more diverse. And Razeen Dinath, the portfolio manager in our team, expands on 2 very important themes that we see emerging in the portfolio. The first is the high concentration that we have in what we call owner-operators. Owner-operators are businesses run by the founders or the owners where they have a significant stake. They're generally very conservative. They have high cash currently. These stocks are boring. They're boring now because they're not really showing explosive growth. And in fact, the managers have decided to raise cash in anticipation of some correction in the market, where they will try to be opportunistic in the future. So the market doesn't like these stocks, but we do. We think they're very cheap, and we think they're very well positioned and in line with our view. The second point is that we're also finding some opportunities in compounding businesses that are franchises, global franchises, that can compound at a steady rate, irrespective of whether the economy struggles or even where the markets fall. So globally, things are a little bit better for us, more opportunities. In South Africa, unfortunately, things are not as easy for us. We think that generally the fact that central banks have been accommodating has really impacted South African equity market in a way that doesn't suit our style. 70 to 80% of the market is overvalued in our opinion. Not even on our radar screen, not even worthy of investment. We didn't like these stocks a year ago. We definitely do not like these stocks today, now that they're higher and more expensive. So really we're playing in a very small portion of the market. And for that reason, this edition focuses on a question and answer format with the portfolio managers of the Momentum Value Fund and the Momentum Small and Mid Cap Fund, where we expound on the key things that we think investors have to focus on. The fact that value investing works in the long run. It works really well. The empirical evidence is very compelling. While it works in the long run, it doesn't always work. And there are market conditions that suits value investing much better than others. We speak about African Bank and why this is typical of a value investment that we've made in the past very successfully. How while this outcome in African Bank has been very negative in the sense that it's gone to zero, it is certainly not because our process is wrong. We accept and we're very accountable for this particular loss, but at the same time we want to emphasize that there have been many other stocks, not only in the last year or two, but over the last decade or 15 years, where we've used the same process and we've had much better results because the process does work. We expound a little bit on the fact that we think markets are distorted right now, and we feel that ultimately central banks have really propped up the market and that there is a negative outcome somewhere in the future. We fully expect then that our process will pay dividends. We finally emphasize in that Q&A session that the remaining portfolio that hasn't really changed is still very well positioned. It's undervalued relative to the market, trading at a price to book of just over 1, a P/E ratio of just over 10, on very depressed earnings on a normalized basis. We cannot find any other stocks, as we've said before, that in the market or the market overall that offer better and more compelling value. So we believe the portfolios are well positioned, and we certainly have very high hopes that investors will have a great return, and then even if the market corrects, that our portfolio will be much more resilient than the overall market. So as we enter the final third of this year, we're optimistic that our style will work, and we're also optimistic that our stocks will hold up much better in the latter part of this year. Thank you.